going to share. So I've started recording now. So basically what I was trying to describe, because we've started talking about indicators now, if you can see my screen. Am I sharing my screen yet? Share screen. Okay. Okay, now I'm sharing my screen. So we have looked at MACD, we have looked at ADX, we have looked at stochastic, those three indicators. Now we're looking at Ichimoku, and I complained that I mentioned that the reason I stopped using Ichimoku, not because of its efficacy, but actually because it is very messy. It takes up a lot of space on the chart. It makes your chart look messy, and sometimes because of that, it might be difficult to follow. So yeah, I also mentioned that when trading Ichimoku, you need to at least use 2 time frames. Like I said earlier, we were looking at the daily chart. Once your price is trading above the cloud, this whitish zone that you are seeing is the cloud. Once price is above the cloud, it is bullish. Once price is below the cloud, it is bearish. So if we look at 4 hours, right? If we use 4 hours as our long-term time frame, we can see that at this point, this red line, the market actually turned bullish. It closed above the cloud. Market has turned bullish at this point. So we can go to a lower time frame. I usually like to use 15 minutes. We go to a lower time frame of 15 minutes. Let's go back to where we had that bullish close on 4 hours. This is the bullish close on 4 hours, right? Then I'll now look for any bullish close or bullish rejection on 15 minutes that coincides or that confirms the bullish price on 4 hours. 4 hours is bullish, so I'm looking for bullish entries on 15 minutes. So we have a bullish entry here. You can see price closed above the cloud, came back and found resistance off the cloud, and you can see there was a nice strong move there, over 200 pips on that move alone. You can see here that market came and found rejection off the cloud again, and you can see there was another bullish move. In this case, it was about 50 pips. Later that day, the market found support off the cloud again, and you can see that led to an about 150, 160 pip move. So like I said, once your higher time frame is giving you one direction, you come to the lower time frame and look for any signal that confirms that direction bias. You can see that there was a very strong sell here when it closed below the cloud here, and you can see there was a strong sell. But because my higher time frame is telling me that the market is buying, I'm going to ignore this sell. Even though it's a very strong sell, I'm still going to ignore it because my higher time frame is telling me that the market is buying. I hope you understand that. So now we can see we have another bearish close here, which we are going to ignore. But some moments later, we could see there was a bullish close here. After that bullish close, you can see that the market went up about 130 pips. So on the lower time frame, you're just looking for anything that is going to confirm the bias of the higher time frame. Higher time frame of 4 hours is telling us buy, 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 buy. So you come down to 15 minutes, which is the lower time frame, and you look for any opportunity to buy. Anytime Ichimoku tells you buy on 15 minutes, you buy in the direction of the 4 hours. If you remember, we were talking about trends. We said there's the long-term trend, there's the medium-term trend, there's the short-term trend. The best way to trade is to identify the long-term trend, which we identified on the 4 hours. We'll use the 4 hours as our long-term trend. And then you look for any time the short-term frame coincides with the bias of the long-term trend. That is, long-term trend, 4 hours is buying. Short-term trend, 15 minutes, you look for any opportunity to buy. If your 4 hours, your long-term trend is a sell, then you go to 15 minutes or maybe 1 hour and you look for any opportunity to sell on your short-term trend. You're always looking for any time the short-term trend aligns with the long-term trend. You can see there was another strong bearish move here, which we are going to ignore because our long-term trend is what? Buy. We are only interested in bullish signals. You can see there was another one here, which led to about an 80 pip move. And presently now, this is where we are in the market. This is the most recent price action at the moment. If I see a bullish close, if this 15 minutes should close above the Ichimoku cloud anywhere around here, that would be another opportunity for me to buy. That is how you trade Ichimoku. It is visually complex, but when it comes to using it to trade, it is actually quite straightforward. Another thing to take note, another thing that people trade in Ichimoku, you can see these two, this blue line and this red line. They act almost like moving averages. Let me put it that way. You can also come back to the 4 hours, right? And look at the direction of those moving average. You can see that on 4 hours, the red is trading below the blue, which is in itself a bearish setup. Remember, if we're using the cloud, this is a bullish setup. But if we're using this blue and the red line, this is a bearish setup. And if you actually come down to your 15 minutes, you're going to be looking for any time it started somewhere around here. You're going to be looking for any time the red crosses below the blue, which is somewhere around here. And you can actually see there was a bearish move here. So those are two ways in which you can trade Ichimoku. You can either use the cloud. If you're not using the cloud, you can use those blue and red lines, which act pretty much as simple averages. But when we get to simple average, you get to understand that a little bit more. But for what you need now, just concentrate more on the cloud. That is, if your higher time frame is above the cloud, go to a lower time frame and look for any time the lower time frame closes above the cloud and you buy. If your higher time frame is below the cloud, go to your shorter time frame and look for any time that shorter time frame closes below the cloud. That is Ichimoku for you. Now, we've talked about ADX moving average Ichimoku. Okay, for Fibonacci, I will skip Fibonacci. I'll maybe talk to a friend to come and give us more in-depth analysis of Fibonacci. Fibonacci is very technical. I'll come back to it once we have a full understanding of how to trade. Then I'll come back to Fibonacci. The reason I'm saying so is because Fibonacci is very technical. I don't want to confuse you or complicate your trading journey, your trading experience too much now. by introducing Fibonacci. Once you have a better understanding, then I can bring up the issue of Fibonacci, and then maybe we can look at Elliott waves. For those of you that like mathematics, you now start counting your wave structure. So yes, that is Ichimoku, pretty much. Let me delete Ichimoku. So we're back to our plain chart. So the next thing we're going to be looking at now is moving averages. Now, if you read 101 books on moving averages, you are going to be given 101 different strategies on moving averages. Sorry, you are going to be given 101 different values of moving averages. Whatever value you use, you need to understand how it works and understand the parameters it is working with. So what is a moving average? A moving average, just as we understand the word average, if you have 10 numbers and you're finding the average of those 10 numbers, what you are doing is you are looking at, you add all the 10 numbers together and divide them by 10. That will give you the average of the 10 numbers. So, and in Forex, you know, we are very particular about the close price, the price at which the market closes for a particular candle, because whatever happens in the candle, no matter how high the candle goes, or no matter how low the candle goes, the price at which that candle closes at, that is the close price. That is what tells us what happened in the candle. The candle might go so high, but it will still come down to the close price. That means that this close price is significant than the high or the low or the open. So if we are going to take a 10-period moving average, what it means is going to calculate the close price of the last 10 candles and find their average. That is pretty much what it's going to do, and it's going to now draw a graph on our chart using that information. Go to moving average. We'll first of all start with 10. Exponent. There are different methods of moving average. There's simple, there's exponential, there's smooth, and there's linear weighted. The simple just calculates the moving average as I have just described. The exponential is set up in such a way, we won't go into how the calculation is done, but it's pretty much like the simple, but it's designed in such a way to react faster to price action in the market. Smoothed is designed to react a little bit slower to the market, and linear weighted is tend to even be more smoother, less reactive to the market than the smooth moving average. But I prefer to use exponential because it reacts faster to the price of the market. So we can see this is a 10-period moving average. So at every point in this line, it is calculating the close price of the last 10 candles. You can set up your moving average to calculate even other things apart from the close price. But for all intents and purposes, we will leave it at the close price. Method is exponential. Let's look at the difference between the 10-period moving average and the 10-period, sorry, let me introduce another one here. Moving average, 10-period. Let's make this red and let's make this simple so that you can just see the difference between simple and the difference between the simple and the exponential. The exponential is in blue, the simple is in red. So I'm going to remove this since we are focusing more on the exponential. So basically, the most basic way of using moving averages is in relation to the market. What is price in relation to the moving average? Sorry. If the price is above the moving average, that means you are in a bullish territory. If price is below the moving average, you are in a bearish territory. That is the basic thing about moving averages. If price is above a moving average, it is bullish. If price is below the moving average, it is bearish. The lower the value of the moving average, the faster it reacts to market. And the faster it reacts to market, the higher the tendency you have of it giving you a false move. For example, from this part of the market to this part of the market, sorry, from here to here, market was bullish, right? You can see it was clearly bullish. At most parts, you can see market was trading above the moving average, but at some times it closed below the moving average, giving you a false sense that the market has changed direction. That is the problem of having a moving average with a low value. Now let's introduce another moving average with a higher value. Let's do 21 now. Let's make the color red. Let's make it exponential. You can see that the red line doesn't move as fast as the blue line. The red line is a little bit slower than the blue line in moving. That now introduces us to another concept in the use of moving averages, which is the moving average crossover, which simply what it does is whenever the moving average, a faster moving average, that is a moving average with a lower value, crosses above or below another moving average with a higher value, that's a slower moving average, because like I said, the higher the value, the slower it reacts to the market. Whenever the faster one crosses below the slower one, there's a change in trend. Recall I also said in the previous video, I said that indicators are usually lagging. They lag behind the price. Price would have already done what it wants to do, or whatever it wants to do before the indicators catch up. But sometimes it can just give you the general direction of the market. You see, when this crossed over here, you can see market still went down a bit. When it crossed over here, you can see market went up a bit. This is the crossover here. You can see market went down. This is another crossover. So basically, that is it. Although personally, I do not trade crossovers because crossovers are too far behind the market. Now we have looked at 10, we have looked at 21. I'm just giving you some popular figures. If you start reading books about moving averages, a lot of them will touch 9, 10, 18, 21. But personally, one that I like using and I've found to be very, 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 very accurate is the 50-period moving average. 50-period exponential moving average. Let's make that white for all intents and purposes. Now you can see it reacts a little bit slower to the market, but it also, because it reacts a little bit slower to the market, it doesn't change as quickly as the others. It doesn't change to every little move in the market is not affected by the 50-period moving average. Now, if we take a look at this, if you recall, my first statement about moving averages, how it's used is that whenever price closes below the moving average, you are in a sell territory. Whenever price closes above the moving average, you are in a buy territory. Similar to how we looked at the Ichimoku, right? Whenever price closes below the moving average, you are in a sell territory. It closes above the moving average, you are in a buy territory. You can see that there are some times, for example, remember the blue is our 10 period, is the fast moving average. The red is, let's say, the medium, while the white, the 50 period, is our long term. And you can see on the red, you can see there are times that it gave you a bullish signal on the 10 period, whereas for the 20, for the 21 and the 50 period, it was still telling you that, look, the market is still bearish. That is a clear example of the fast moving averages giving you false signals. So the use of moving average, you really need a moving average that doesn't react so much to every little change in price action, every little change in the market. Now, even looking at crossovers, you know, I told you about crossover. You can see crossover when both moving averages cross below the fast moving average. You can see it led to a very big move here. If you look out for the same thing here, there wasn't such a big move here, but you can see here, there was another big move, and so on and so forth. But really, I don't like using moving average crossover simply because they lag too much. They lag too much. Now, I still want to introduce another moving average. Let me take out this 10 period moving average, right? And let me make it 100. So I'm going to change that 10 to 100. And you can see that even as slow as the 50 period is to reacting to the market, the 100 period is even slower. And you can see the line is a bit smoother, and it eliminates, let me just delete this one, and it eliminates any false move, let me put it like that, in the market. And if you actually look at that 100 period moving average, you can see both the 50 period and the 100 moving average. You can see that it acts like a support, a dynamic support or resistance to the market. You can see that when in an uptrend, you can see that, let me remove the 50 period so that it doesn't, let me remove the 50 period so that it doesn't confuse us. You can see that whenever price touches the 100 period moving average, there's a rejection. You can see price turned bullish here, touched the 100 period moving average, and there was a rejection up. Touched the 100 period moving average, rejection. Closed below the 100 period moving average, but immediately reversed. There was bullish move, rejection, rejection. Anytime market touches the 100 period moving average, you get that reversal. So it's acting kind of like a dynamic support to the market. Now we have fixed support, which is your support and resistance, which we covered earlier. But this one, you can see it's moving with the market. It's not just a fixed line that, okay, anytime price touches this line. But this one, it's like it's a position in the market. Anytime market gets to that 100 period moving average, there is a rejection, which still further confirms your bullish bias on the market. So that is moving averages, pure and simple. Now, how do I maximize these moving averages for my trading? I've been talking about moving average, moving averages, moving averages, moving averages, moving averages. How do I maximize this for my trading experience, right? Sorry, I have some open trades in over there. That's why I keep checking it from time to time. Don't mind me. Now, how do I maximize this? One way you can do it is just like I've shown you. Whenever you see a rejection of the 100 period moving average, you can decide to buy. If it's in a bearish, let me look for when market was bearish, because gold has been quite bullish for quite some time. Okay, you can see here, market turned bearish on this candle, closed quite clearly below the 100 period moving average. And you can see at this point, market got to the 100 period moving average and there was a rejection. And you can see that it sold. So that is a sell opportunity on the 100 period moving average. But, you know, I always try to make this point that anytime you are trading, you always use a minimum of 2 time frames. You have your higher time frame, you have your lower time frame. The higher time frame gives you the overall direction of the market, and on the lower time frame, you are looking for any opportunity to follow in the direction of the higher time frame. So what does that mean? Sorry, a second, please. Okay, what does that mean? We're looking at 4 hours again. Now, as I said, I like using 4 hours as my long-term time frame. When you start going into your own trades, when you start doing your own personal research, you might want to use a different combination. I know people that I use 4 hours and 15 minutes, 4 hours as my long time frame, 15 minutes as my entry, as my short time frame. Some people use daily and 30 minutes. Some people use weekly and 4 hours, depending. You just find the combination that works for you. Now, looking at that, we've looked at 4 hours, right? We've looked at 4 hours, and we've seen that on 4 hours, the direction is bearish. Market is trading above the 50 period moving average. Let me remove this line quickly. We can see at this point, market closed bullish above the 50 period moving average. Come here again, there was a bullish rejection. I just want to identify all the bullish rejections in the market, right? So that we can go to our lower time frame and now look for trading opportunities. Like I said, just as we did in Ichimoku, we're going to be looking for anytime the lower time frame corresponds with our higher time frame. Do we still have any? Okay. So we had the bullish confirmation here around this zone. And you can see on 15 minutes, you can see bullish rejection of the 50 period moving average here, which led to a buy. You can see bullish rejection of the 50 period moving average here, which led to a buy. You can see rejection here led to a buy. You can see a close above here, which led to a buy. A rejection here, which didn't actually lead into much of a buy, like no system is 100%. See another rejection here led to a buy. Another rejection here wasn't much. Another rejection here led into a strong buy. We have another rejection here, buy. Another rejection here. So these are clear examples, right? of how just using the 100 period moving average alone and looking for the rejections, looking for the lower time frame to correspond with the higher time frame. Here's another bullish close. Here's another bullish close. So it would have given us several opportunities to buy. Now that is just looking at the 50 period and the 100 period moving average alone. Now, in the next class, we're going to be looking at how you can now incorporate a set of moving averages together. We're not primarily looking at crossovers now. We're just looking at how to put moving averages together to give us an even more accurate trade entry. I've shown you the 100 period moving average now. I've shown you the 10, I've shown you the 21, I've shown you 50, I've shown you 100. Now, in the next class, we're going to put all those things together and begin to play around with it and start looking at how we can now start actually executing trades. That's going to be in the next class. So basically, this is it. This is just the introduction to moving averages. In the next class, we are going to take it up a notch. Start looking at how to combine all these elements. Looking at moving averages, more moving averages, how to correctly implement two time frames, a higher time frame and a lower time frame, and how you can now start executing trades. And with that, I believe you guys will now be able to start making trades on your own. You will now be able to start identifying setups in the market and now start executing trades on your own. Like I said, I'm always going to be around to guide you, to give you, if you see a setup, you can discuss with me. I'll be able to analyze it further, give you my thoughts on it and things like that. But basically, that is it. From the next class going forward, I'll be expecting that each and every one of you that have gone through all the courses will now be able to start executing trades on your own. That's going to be the next class. That's what we are going to be looking at. So thank you for everyone that participated. Those of you that are going to watch the recorded video, if you have any questions, please don't hesitate to chat me up and ask me whatever questions you might have. So the next class will be coming up later today sometime in the evening. So I ask that you guys get prepared to join that class. So thank you very much, everyone. Have a lovely rest at home.